So what would you say right now your the breakdown of your sales are?
So, I mean, we don't really go into great detail, but I would say that a substantial portion of our sales is in each asset class, right? So we do a fairly substantial amount of cash business. We do quite a lot of leases. We do quite a lot of loans. We do a good bit of PACE. It's, again, more geographically specific. We do, in SREC markets, you have sort of SREC-based financing offerings. Everything that we sell has double-digit share.
Yeah, and you mentioned regional differences too. I'm wondering if Sarah can talk about that a little bit. We see in certain states, particularly Massachusetts and New York, higher levels of customer ownership, especially when you take out the top few companies who are just offering the leases and PPAs. Have you noticed any of those regional differences? Is there a reason why in the Northeast and in those states we're seeing more customers who want to own their own systems?
Well, being a Northeastern myself, I can make a really snarky comment about intelligence levels in Massachusetts. We like to think we're the smartest state, right? So, I think it's interesting to look longitudinally at how leases have performed in certain markets. And certainly in Massachusetts, you saw that rise of third-party ownership, and now it has begun to fall off. And I think there is like this herd mentality where people are starting to talk to one another and starting to really parse out these options and get smart on what it means to rent out your roof versus own your roof, right? So I think that's part of what's going on. I just want to pick back up on the point that Sandy made around, if there's a cost of capital advantage, we'll all rush in one direction. I think that's to some degree true, but I think we would all say that, home equity is cheaper than all of us.
If you have it.
Right, but it just doesn't work, right? So it goes back to this trade-off of cost of capital and process. Both have to be there. SolarCity is the most expensive option around. Right? And yet the fact that they've outsold home equity, you can just see customers prize ease and process. So that's really how we see our job as a loan provider, is to make the process of solar ownership just as easy as SolarCity makes leasing, right? Because it's not just about the cost of capital. Like you guys wouldn't build your business around.
No, I think that's right. Complexity and complexity and ease of deploying the product. I think it absolutely has an important role in getting a HELOC. Number one, you may not be able to. Number two, you got to go to your bank, and there's no way to just sort of productize that. But I think that the different asset classes. There's plenty of parties out that are attempting to solve the financing riddle in different ways, and that level of activity I think is great for customers. It's good for installers, and I guess it's because of that level of activity. It's why I don't spend any sleepless nights worrying about things that John was talking about. I think there's always going to be options that are available.
If you set those products as all the same ease of use, people are going to gravitate towards the one that's got the lowest monthly payment.
Yes, all things being equal, then people like to pay less for
whether I own it, whether I don't own it. They're going to go for savings, and I think 20 years, whether it's a loan or a PPA, it's so far in the future. I think that people are less concerned about ownership versus really what are the monthly savings.
Great. So I want to go back to John. Sunnova is one of the few remaining leading companies in the space that has not shown any signs of offering a loan or even the customer ownership offer at all. Do you see that changing at any point, or why have you taken that approach?
Well, I think it starts, first of all, I think a lot of this discussion that we have as an industry, we actually take something and make it much more complex than it really is. At the end of the day, what we need to be discussing is this what we do as an industry, a product or service sale, period. What goes with the lower cost of capital, as you know, Christian, is do I have good service? And we are competing against a service industry. The centralized utilities are providing a service, not a product. And I'd like to see it. You got my contact info here, but I'm really trying to find something in the economy over the last few years, particularly the sharing economy, that's gone from service to product. I can name a lot that's gone from product to service. So if we answer that question first, the next one is, what is this PPA and lease and the components there? And this gets into O&M. I disagree. I think O&M is critically important. And a number of banks now come to the same conclusion that if you have a FICO score of 800, but the thing doesn't work, you're going to find a reason not to pay. because that's the way consumers act in this country, for better or for worse. The components of a lease or PPA are three components. It's very simple. It's an equipment loan. It is a loan. It's no different than going down Verizon and getting cell phone service. Embedded in that is an iPhone loan, or whatever phone you picked. The second piece is the ITC/depreciation, the tax assets, which are, of course, different than a cell phone contract. The third piece is O&M and service. You have to pay for insurance. Service is not free. And when you discount and don't put service in there, you are doing a disservice to the customer, and the industry is going to pay for that when all these systems are not working and they're trying to figure out who to call and what prices to pay to get this stuff to work. I can speak to that personally firsthand. So if you go back and you look at this whole debate we're having, Christian's right. The real thing is Sarah needs to be in D.C. campaigning for the ITC extension, because when it goes down, the loan business, who's kidding who, there's going to maybe a brief boom here in the first part of 2015, but it is over. It is gone, because you can no longer manipulate the numbers to say that you're getting, quote, a better deal if you don't have the ITC, to Christian's point. He's absolutely right. At the end of the day, what we need to do is go back in and take a look at all this analysis and say, then what we're really talking about is, as long as you can come through and add each of those three components up, like Solar City did with their loan, then you can have a system or a loan product, a retail installment sale technically, where you can essentially just take that tax credit and give it to the homeowner, because, again, the tax equity market is tight and the cost of capital of monetizing that investment tax credit is too high relative to the homeowner being talked into monetizing it themselves. That's all he's done. That makes sense, as long as the ITC is there. Once it's gone, then you're back and you miss that middle variable, if you will, and you're right back down to just an equipment loan, which is cost of capital, as we've all agreed on, and O&M service contract, and that's it. So it's going to go back to what's easier to do. What's easier to do is not get into some loan product and figure out, who owns what and everything else, and it's an ease of transfer when you sell the house. And that is a lease or a PPA. It's a service business. It's not a product business.
Mm-hmm. So I do want to talk about 2017 and what's going to happen, and kind of pose a different question to each of you. And just to clarify first, so end of 2016, the 30% ITC completely goes away for customer-owned systems, and for any commercial systems, which includes third-party owned, it drops to third-party owned residential systems, it drops to 10%. So with that, first, I guess we can start with you, John.
I cannot wait
till
the ITC is gone. It's
really?
something
Okay.
that if you look at it, the government has come in and they've really given us false price signals in the industry. And just like the Europeans, when they took out the rebates that were so healthy and everybody had a bad time, it was an awful period of time. But at the end of the day, what happened was, after the dust settled and we thought this was going to happen, then real true capital moved in. And now the industry has grown globally by leaps and bounds, as we all know here today. We think the same thing happens with the ITC. It distorts offerings and consumers' perceptions, et cetera, about what's really going on in the market, and it really limits us. How much of our industry is limited by the availability of tax equity, or at least the perceived understanding that you need the tax equity to actually make it go? It's a tremendous liability. Get rid of it. Let's just have a level playing field. Let's focus more about having open access with the utilities, not indifferent to or just the same as net neutrality is for the internet business. Let's focus our efforts on that, rather than trying to get government handouts at the federal level that are really not constructed appropriately for the industry's long-term benefit. So I think that we'll be fine. We're actively looking for that day. I will also say this: we will actively campaign, and I think the senators and congressmen from Texas see things my way, just taking a guess, and we will actively campaign to make sure that whatever is put in right now, the 10% limit that goes down at the end of 2016, stays in place. And it'll be good for all of us. I know there will be a lot of disagreement in this room, but I'm telling you, it'll be good for all of us in the long term.
Christian, would you agree with that? And on top of that, how do you think that the market for tax equity will change in 2017?
Broadly, I'd agree. I mean, I think that, despite having kept me employed for the last 7 years running project finance teams for DG Solar companies, I think being able to reduce some of the complexity by having to raise this tax equity would be great. I will say that there's a lot of debate around the begin construction qualification. So what projects started at the end of 2016 will go on to 2017, and it could be a number of years before that 30% tax credit actually really gets phased out of the system. But the real uncertainty in my mind is interest rates, right? So if interest rates, if we can't borrow at less than 10% in 2017, all of a sudden it's going to look a little bit more challenging to finance that solar project at a discount to the utility rate. So, that is the sort of, in my view, the real unknown and risk.
Okay. And with the ITC moving from 30% to 10%, does that make a difference in terms of who is actually active in tax equity investing and what the cost of capital is?
Yeah, I mean, I think that, if you look at a 10% ITC project, you can make a decision to self-shelter the credit and use it with the income that's generated by the project later in its years. So a lot of people will just say, it's cheaper to raise just debt and not have to deal with this tax equity or faster, and they'll make that decision and not raise tax credits at all. I think that's going to be a big piece. You're going to see some markets that are currently in the money for solar just not be in the money anymore. I think that's going to impact jobs and things that Washington's going to debate about. But the big markets like California, are well in the money right now. I mean, and are not going to be. They're not going to miss a step as we go into 2017.
Mm-hmm. So Sarah, what's going to happen to the loan market? How will you survive and compete with nothing?
Yeah, so I'm not. With nothing, you make it sound so
Sorry.
dire.
So dreary.
Put the pressure on you.
Yeah, so I don't think it's that dire.
Okay.
I tend to agree with John too. I think it's been a distortionary policy in the market. I'm looking forward to it going away. I do want a level playing field, so I think it's be kind of not a great idea for our industry to kind of stack the deck against ownership. Mm-hmm. If we want to let preferences reign, and the easiest way to sell more solar is to meet preferences, we don't want to be fighting against policies. We're trying to meet these customer preferences. So, the simple way to put it is we want what Sandy wants. Right? If Sandy wants to sell in a world where his salespeople still have to talk through a tax credit, we'll give him the products he needs to sell that. If he'd rather have a world where he needs to sharpen his pencil a little more and make without the tax credit, great, right? Our orientation is towards our installer partners and making it easy for them to sell in whatever the market conditions are.
Do you think towards the end of 2016, though, we're going to see a big demand pull-in of customers buying systems, or will they just not even realize that?
Absolutely. I'm counting on it. Yeah, absolutely.
And Sandy, what are you expecting for 2017?
Right. So I think a couple things. I think the markets like stability, or we as providers, sort of seek stability, right? So I think, and we're going to have a huge, period of lack of clarity, right, leading up to 2017. Drive a lot of activity in 2016. It'll be a lot of fun. We'll certainly enjoy that. And then there will be almost certainly this period of sort of disruption, dislocation. We've seen this in state markets where you had a generous grant that went away. You'll have these disruptions, but you know what? Then they kind of come back if the fundamental underlying economics are there, as Christian said, right? In markets where you have, California and the Northeast, where you have 20 and 30 cent power. You're going to have a market, and it'll just take a little bit of time to reequilibrate around that new set of economics. I think that. Generally speaking, and I think, incentives going away, I fully agree with John. Incentives are nice, but they create instability because there's this question mark. If you can live in a world without them, then we'll know, okay, that's it. They're not going lower than zero, so, we'll all be fine then. I don't know whether the difference, if it stays at this 10-0 level, I don't know to what extent that would just shift everything back to third-party ownership from loans. I question if that's enough to have a sea change, but, from our position, at the end of the day, we don't really care, right? We just want to be able to have, some economically valuable offering. And I think that's where people get lost a little bit, particularly when we get kind of in our finance brain mode. It's like ITC and MLP and third party and loan. You have to understand what happens at the kitchen table. At the kitchen table, it's about what is this economic offering to the customer. Paying 22 cents today, now I'm going to pay 17 cents, whatever it is, right? That's the offering. Now, and that's kind of the proposal. other things, I mean, I think people need to recognize that these other characteristics of these of products do then come into play. What happens at the end of the term? What happens if I move? All these what if kind of scenarios come up, but they're not the, and then that is what we will use to be like, okay, you know, you could pay 15 cents or 16 cents or 14 and a half or whatever. Oh, you're really concerned about what happens if I move? Okay, well, at the end of the day, this offering here sort of provides the you know, the most assurance that you'll have kind of an easy, you know, easy road there. So our view is, you know, there's going to be a cliff that's going to, you know, there's going to be a party and a hangover. The hangover will, you know, sort of end, and then you'll rebuild around the whatever reality we wake up to, you know, at the end of the hangover.
Great. I'll take audience questions in a second. I just had one other question, which is that, so we have started to see some consolidation, some acquisitions in the residential market, but mostly they've just been installers being acquired. Are we going to see any consolidation among the financing companies themselves, whether it's the many loan companies there are, or the major third-party leasing companies?
Well, I just say that I think, you know, with the uncertainty around the 2016 ITC expiration, it makes sense for a lot of transactions to happen in 2015 before people start really worrying about that. So I think you will, just because of where we are in the tax credit cycle, a lot of folks will seek exits this year where they wouldn't otherwise do it. So that could be public as well as M&A.
Sarah, what do you think about the loan market?
In terms of acquisition targets?
Yeah.
Yeah, I think it's quite possible. I mean, I think, you know, panel providers are an obvious player that are looking for a way to kind of drive sales of their products. So those are one potential class of acquirers. People with yieldcos that want to dump more assets into yieldcos, they might like a nice machine that's producing residential solar loans. So yeah, I think there's a lot of acquisition opportunity there.
Great. All right. Do we have any questions in the audience? Yeah, one right down here.
So good panel, thanks everyone. I'm going to make a joke first, so raise your hand if you went to Harvard. Sorry,
Hide under the chair.
raise your hand if you went to Stanford. Yes, all right.
All right, I'm done.
All right, so now that there's some levity. So lease versus loan, it's interesting to me as a equipment provider, you know, parallel to just think about your car, right? You buy your car, you own it, you walk outside, you wash it yourself, you teach your son how to wash it, you wax it, you walk away, you look back at it, it's shiny, it's nice. You lease your car, you know, you don't care where you park it, there's a ding on the door, you paid for the coverage, you don't really care, you turn it in after 3 years and you get another one, right? So how do you see the difference in the philosophy of the homeowner in your company as it pertains to equipment, quality, et cetera, when we analyze the differences between these two financial products, leasing or PPA versus a loan, where the homeowner actually feels ownership in the system? Is there a difference?
I mean, I guess start quick. I mean, I think, to me, I think the thing that gets lost, back to the points earlier about service and O&M, I mean, I think customers, when they have a problem, whatever it is, we're the party that they call, typically. So, and that's whether they have a specific problem with, you know, something that we're on the hook for or not. I mean, they'll just sort of call us because we're the ones that were in the home, we're the ones that were on the roof, we're the ones that, you know, pulled the permits, we're the ones they know, right? And I think we haven't really detected yet a big difference between customer behavior in lease versus ownership. They still care what panels look like on the roof. If they're inclined to care about aesthetics, they're inclined to care either way. The fact that it's a lease and not a purchase, they still care what their roof looks like. If something's not working or they think it's not working, they still want it to work. So I think there's probably overemphasis on customer attitudes and behaviors based on what financing choice they've made. We don't see that being the predictor of consumer behavior.
To me, that's the biggest thing about the loans that still needs to be fleshed out is the O&M, right? So capital markets will want 20-year O&M attached with this as they do securitization. We're not Toyota or Ford, right? We're not a big warranty standing behind that O&M obligation, and there's this thing called holder in due course, where if you, as a consumer, sign up for a loan, and the item that you borrowed money against isn't working as you expected, you can get out of that loan. And so I think there's a real potential liability there to be worked through that is more about O&M than about the equipment itself.
I would just say that I've heard the automotive analogy to our business quite a lot. This isn't, in my opinion, the automotive business at all. I think that's a product that in many cases defines who you are as a person. You don't walk up into the bar and tell people that you've got a solar system on your roof. You may say, I got, whatever, Porsche in the back, It's just a different business. But, with that, going to a point earlier that I made, going from product to service, if you look at the statistics of the last few years, the automotive market itself is actually growing towards lease. For the first time, I leased a car just 60 days ago. I've always bought them, and I think that had a lot to do with just the level, putting the true cost of financing parity, kind of go back to what Christian said, and you're starting to see the lease just pick up in traffic. Uber's another example of taking something and a lot of people's products and turning them into a service, the cash flow for them. So I think the trend's pretty clear on a macro basis, regardless of this industry.
Any other audience questions? I think we have one back there.
So this isn't so much a question as a comment that I'd love to hear your guys' response to. One of the things I'm listening to the panel, and the impression I'm getting is everybody up there is really underestimating your customer and the intelligence of your customer. So there's been a lot of commentary about they just want the lowest price, or you want to make it simple, or the idea of customer choice here is we know, if you just look at, time of use pricing in our own sector, customers do respond to this. This is not, you can make power more complex and have people track it. And in that same way, John, I've got to push back on this idea that all you're doing is selling power. I buy an iPhone. I don't buy my cell service. My cell service comes with my iPhone. That's a service to product flip. Verizon or AT&T are all trade on the phones and the handsets that they can pitch. And in the same way, while solar systems are tied to the grid, you're not selling power, you're selling a rate. You're selling a contract. That's what third-party financing is. So I'm skeptical of the idea that customers are so simple, especially as we get into a much more service-oriented sharing economy, much more customer choice, much more do-it-yourself and disaggregation, smart home, et cetera, that the idea of structuring products of very binary choices doesn't actually undermine the business as a whole.
Sure. John, do you want to respond?
Yeah, I appreciate your points, and I would agree with one and disagree with the other. I have a cell phone. I had to put it down for the microphone, but I carry it with me constantly. To me, that is by definition, a personal product that is almost inseparable, just ask my wife, from me. And I don't think I'm alone in that. And so that's more of a personal choice. It is, again, a product driven that is connected into the service, which comes from Verizon, AT&T, et cetera. You don't put your solar system in your purse or your pocket. I don't. And I think that separation is actually, when was the last time you were on your roof? I've never been on my roof. So it's to me, that is not a proper analogy as well. But I will say this, that if you go and look at the deregulated power industry, say in New Jersey or Texas, and you see a proliferation of service offerings or products, as they call it, right? And I do think that we'll start to see more and more of that as this industry settles down. The ITC going out the exit door will really facilitate that, I think, where you're going to start to see a lot of different types of service contracts and product offerings that goes to your point, which I would agree with, is that will appeal to certain segments of the customer population. And you see that again I don't have to say that this is going to happen and this has never happened before. This has occurred in the centralized deregulated power market. So We ourselves have a lot of ideas about different service contracts, features, and offerings that we can provide customers. And you will see from us over the next few years a proliferation of different types of contracts rather than just this plain vanilla PPA lease that we all have today. So I agree with that.
And just a quick follow-up on that for Sandy. With regards to consumer choice and consumer preference, you talked earlier about giving the consumers as many options as possible, basically. At what point is there too much to offer, and how do you figure out which options you want to offer each customer?
I think there's a distinction between offering options and offering every conceivable option, right? So like we never go into a home and it'd be like, well, there's 19 things you could look at here. Let's walk through them. There's maybe 2 or 3 at the most that in any given situation, and usually you can kind of quickly boil it down for any given customer what what is going to be most likely to work for them. To kind of say, I think again we get trapped up in our own overanalyzing here, all the Harvard and Stanford, all that stuff here, right? So it's not like consumers are X, they're simple or they're complicated or they want choice. There's 100 million or whatever households in the U.S. There's a lot of different types of people out there. I think you go in and fundamentally this is a way to save money and control your spend. Okay, that's sort of fundamentally what this is, and we go into the home and say, okay, you can save, you can fix your spend and save money. And then you kind of peel back the onion and go into a little bit of detail depending on what that consumer predilection is, right? What is it that they're interested in? And then you usually find one option or another, or a choice between 2 is kind of what carries the day at the kitchen table.
Great. All right, we've gone well over our time now. We're going to move into a break now, and thank you to my panelists.
Thank you.